You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
Welcome. Thank you for attending tonight's Becker Friedman Institute event. I'm Lars Hansen, the director of the Institute. I'd like to take this opportunity to thank Charlie Plosser for agreeing to participate in tonight's event. I'd also like to acknowledge generous supporters, University of Chicago alumni Don Wilson and Eddie Allen for their gifts to the Institute that allow us to explore critical questions in monetary and fiscal policy studies. The Institute supports research on important policy questions like the ones we're exploring tonight, but it's also an important part of our mission to bring research-centered policy analysis to broader public events. And so we're really happy that you're all here, and really happy to have our featured speaker tonight. Tonight's talk is an extension of a successful event we held in January at the Chicago Fed with Charlie Evans. I thought Charlie ducked all my hard questions, but there's a challenge down to Charlie Plosser. But no, it was. We're very grateful for his willingness and Charlie Plosser's willingness to participate. Tonight we'll hear a different, interesting perspective from another Fed president. So let me just talk very briefly about Charlie. He served as president and chief executive officer of the Federal Reserve Bank of Philadelphia from 2006 to March of 2015. During his term as president of the Philadelphia Fed, Plosser and his colleagues faced challenges of the global financial crisis followed by severe recession. The Fed took unprecedented actions in both monetary policy and in its lending operations that were intended to mitigate the effects of financial crisis. Prior to that, if I go back further, Alan Meltzer and Carl Brunner formed, I think they formed what's called the Shadow Open Market Committee, under which some outsiders were kind of were giving external perspectives on what the Fed was doing, and I believe that Charlie Plosser was a member of that committee for a while, and I guess that was good practice for his subsequent position. Anyway, before coming to Philadelphia, Plosser was the John M. Olin Distinguished Professor of Economics and Public Policy, the director of the Bradley Policy Research Center at the Simon Graduate School of Business, and he also served as dean from 1993 to 2003. I don't want to forget the fact that Charlie earned his both master's and doctoral degrees from the University of Chicago, so we're proud to have him as an alumnus. Well, with that, I think I'm going to sit down and begin our conversation. The plan tonight is I'm going to ask him some questions, and then time permitting, we'll open up to the audience to have some other ones as well. So I thought I'd start off with discussing the Fed the targets of Fed policymaking. Some economists, recently we had John Giannakopoulos talk at the Institute, arguing that the Fed should pay less attention to short-term interest rates, and that really they ought to be focusing on much broader set of financial market indicators. In his case, he makes reference to the so-called credit surface. This surface relates the cost of credit to FICO scores, loan-to-value ratios, and other variables, with the idea that it's a broader base of credit opportunities that are really critical to nurturing investment. He and others assert that this curve is more relevant as a policy device, and think it's now time for the Fed to rethink the scope of monetary policy systematically going forward. So I ask you, Charlie, should the Fed now be constructing alternative targets for monetary policy in face of this rich array of financial markets and the opportunity to influence them?
So that's a great question. By the way, I'm delighted to be here. Before I answer the question, delighted to be here. It's kind of like coming back home after many, many years, and I've been visiting the campus here for the last month, and it's been great seeing old friends and former colleagues and former teachers even, and it's been great. By the way, I don't think I've ever been interviewed by a Nobel laureate before, and you know, it's a little intimidating. But I'm delighted that Lars invited me to come do this, and it's really quite a pleasure and an opportunity to visit with Lars. And I've known Lars probably for 30 years, something in that order, and so it's great to be back. So let me talk a little bit. So I think the question about monetary policy and about financial issues is really about, well, what do you think the goals and objectives of monetary policy really are? So there's a huge debate growing in central banks. Obviously, since the financial crisis, if you look at both the academic literature and the policy literature, the big debate is now the focus is on financial stability, whatever that means. It's not defined very well, but it's this notion that financial stability. And so one of the things that we need to think about is, so what's the relationship between financial stability? What's the relationship between regulation and supervision of the financial sector? And how does that relate to monetary policy more directly? I think that's a really tough question. Certainly for years, the Fed has had a responsibility for monetary policy. And of course, monetary policy, according to the Federal Reserve Act, is about what we call the dual mandate. And now we can debate that later if you want to. But about the dual mandate, which is the Fed's monetary policy is supposed to achieve price stability and maximum employment, so-called dual mandate. And so the question then becomes, what's the best mechanisms for doing that? The Fed has also had this responsibility as a regulator. Primarily up until, the recent crisis, I suspect, the Fed and many other regulators thought of themselves as ensuring safety and soundness of individual institutions, so that the transmission, if you will, of monetary policy through the financial sector worked effectively and efficiently. So I think the underlying theme of Lars's question has something to do with, well, how do these two things interact? How does the challenge of supervision and regulation, how does the challenge of financial stability relate to monetary policy? I think those are very difficult questions, and there's a lot of research being done these days. I think at the Fed and among most macroeconomists and monetary economists, we used to think, or we typically think, that monetary policy is about price stability and maximum employment. Financial stability was this other thing over here. And the challenge now seems to be one of deciding to what extent do you use the tools of traditional monetary policy to achieve the financial stability issues. The other thing that's a huge question. So do you want to, so to the extent that those two goals, financial stability and monetary policy, might be in conflict with one another, how do you make trade-offs between those two? Do you raise the interest rate, for example, in order to protect against financial instability, and therefore put at risk your other goals of monetary policy? I think those are really deep questions for the macroeconomy and how we think about monetary policy. I mean, in another dimension, Lars' questions and the stuff that Giannakopoulos has talked about is that, well, let's go back to what Friedman told us. Friedman focused on quantities, not on prices. Interest rate's a price. And so Milton used to focus on the quantity of money and the quantity of credit. How do we think about those things? Should the Fed and its goal and monetary policy think about controlling quantities? And if so, how do you think about kind of the credit service and the structure of credit markets given the way they operate today? I think those are all kind of very open questions. But I think you do have to be careful about to what question this is the answer to. So if you believe that manipulating credit and the credit surface, as Giannakopoulos talks about, think about what are you really trying to do? Are you trying to achieve your goals as a monetary policymaker? Or are you trying to achieve your goals for financial stability? And what happens when those two things are in conflict with one another? Technically speaking, the Fed has no mandate from Congress to directly achieve financial stability in current law. And there's a great deal of debate about whether you want to add yet another mandate to the charge of the central bank, and yet another mandate that might put its other mandates in conflict with one another. So I think these are very open questions, and maybe we'll get to this later, but I think my own view is that I think we have to be very careful about asking central banks to do more in some sense than they're capable of. And I gave a speech a couple of years ago, and the title of it was "A Limited Central Bank." And so if you want your institutions to be successful, to be credible, and to achieve their objectives, my sense is that narrowing their objectives rather than broadening them are likely to lead to better outcomes. But that's probably a different conversation.
Okay. So let me continue on with financial markets. So financial markets, they're forward-looking. They serve as a barometer of people's beliefs, perceptions, confidence in the economic scene. For instance, also, some economists claim to be good at spotting so-called bubbles. We could have a long conversation about what a bubble really is, since I'm never quite sure what the operational definition adopted by the press and policymakers of a bubble is. But more generally, as a policymaker, in what ways did you find financial markets useful as a guide in policymaking? Like, would you look at the term structure of interest rates in order to make guesses as to what people's confidence in the future and the like, and would this have an impact on your decision making?
Yeah. So I think there are a couple of interesting dimensions to this. One is the question of bubbles, and I think Lars and I probably see this. I don't know what a bubble is. I certainly think that if you those that, I kind of draw an analogy, if those that people that think they were excellent at identifying bubbles, whatever they may be, I'm kind of reminded of sort of what I learned here in Chicago about mutual fund managers and the ability, if they were successful, was it luck or was it really insight and for our knowledge? I think the track record, if you will, of either economists, but more importantly, policymakers, to know whether you have a bubble or not, regardless of how you define it, is pretty poor. And so I think the idea that somehow you can construct policies based on a decision that you know you have a bubble or not is a pretty dubious proposition from the get-go. So that's sort of one part of that. The broader question about how you use financial markets, I do think that financial markets have a lot of information. Financial markets tend to be forward-looking. But I think as a policymaker, two caveats have to be kept in mind. One is that the financial market forecasts implicit in forward and future prices and other things doesn't mean that's the truth. It may be at best an unbiased expectation, but it doesn't mean that's what's going to come to pass. And so somehow you also have to keep, in fact, the uncertainty that surrounds whatever happens to be in those forward prices and financial market prices. So that's one part of it. And I think I sometimes refer to the quip by Paul Samuelson that the stock market predicted 9 of the last 4 recessions or something like that. So I mean, So I think what you have to do with financial market information is, even though it's forward-looking, is that there are lots of things that can affect that forward-looking price. And what happens sometimes is that interpreters of those forward-looking prices oftentimes want to attribute that price or that signal as all one thing or all something else, when in fact it's the agglomeration of lots of different pieces of information. And I mean, one of the great examples of this is TIPS measures of expected inflation. So we have these things called TIPS. We have break-evens from these TIPS. Many people want to interpret that spread or that break-even as a forecast of inflation. But what we've come to realize is that there's more than just that in these break-evens. There's things about term premium, risk premium, inflation premium. Those things change and they contribute to the fluctuations in these TIPS. And being able to identify the portion of the movements in the break-evens that are really about inflation versus something else is actually quite difficult. And so yes, financial markets are forward-looking. They're important pieces of information. And the last piece of kind of caveat I would put on it is that I think policymakers, particularly monetary policymakers, have to be a little bit cautious, because whether or not in some markets, let me take the Fed funds market, where there are future prices on what the Fed funds rate's going to be. That's interesting information. But is that information about what you think is that a statement about what policy is going to be, or is it a statement about the economy? And how you disentangle those pieces, and then as a policymaker, what signal you take from that, you know, it's kind of, you got to think hard about that and what it means and what you want to take away from some of those signals. So I think it's partly about measurement and about noise and other things that are going on. And it's also about what pieces of those forward-looking financial prices are relevant and pertinent for a policymaker as opposed to a trader. As a trader, it tells you one thing. It tells you something very important about how you want to act or how you want to behave. But as a policymaker, you got this sort of identification problem is, are they really just forecasting your behavior? Or are they forecasting something more fundamental about the economy or something else? So if they're just forecasting your behavior, then as a policymaker, you sort of, oh, wait a minute, all right. Do I want to live up? I mean, this is about me, or is it about something else in the economy? And those kind of signals kind of get mixed up a lot. So yes, financial markets are important. They tell you information. The challenge is disentangling that information from perhaps other things. A specific example, let me go back to break-evens in the TIPS market. So at the height of the European crisis, let's say back in 2010, 2011, 2012, break-evens were doing very strange things, and the TIPS markets were behaving in some unusual ways. But a lot of that was driven by European flight to safety about fears in Europe. And so you had these effects of sort of big flow of funds in a market that wasn't very deep. Trading was relatively thin compared to, let's say, treasuries or some other markets. And so did you want to really interpret the changes in the TIPS market and the changes in the break-evens as information about inflation, or was it information about the scarcity or safety flows from Europe to the United States? So those are the examples that you sort of have to take into account. And so financial markets, I think, are very useful, but I also think you have to, at the end of the day, think hard about what you take away from that and what it really means as a policymaker.
So let me change things a little bit here. Hayek wrote a rather intriguing Nobel address challenging the extent to which economics is actually a science. I don't agree with all of that address. In fact, it's a very fun and enjoyable read, actually, but it's provocative as well. But there's this one statement in here I'm going to lift out of it because I find it quite interesting, and I'm sympathetic towards it, I suppose. Even if true scientists should recognize the limits of studying human behavior, as long as the public has expectations, there will be people who pretend or believe they can do more to meet popular demand than what is really in their power. I also am reminded of, you brought up Milton Friedman earlier, and in his views on monetary policy. One of his arguments was for a very simple policy rule, a so-called K% rule, in part because of so-called long and variable lags and kind of the monetary transmission mechanism to the real economy. It seems like it's a statement of not a full understanding of how that mechanism works. So with Hyatt's quote in mind, with Friedman's quote in mind, let me put on my econometrician's hat. There's scope for the greatest divergence of opinions when historical evidence is weak. This has been seen, for instance, we have discussions of the impact of fiscal stimulus, but it's also true in some people's call on what monetary policy to fix the economy. As a policymaker, how do you confront this uncertainty, the limits to our knowledge or understanding of the complexity of the economy, and how does that make you think about the design of policy and the conduct of it?
Yeah, so this is actually, in many ways, very fundamental. I think as an economist and in my years as an academic and building models, and I think that, we have to understand that there's still a lot we don't know. There's still a lot we don't understand. Models are incredibly valuable and important and help us structuring how we think about problems. But they don't always give you the precise answers that you'd like to have. So I want to take two strands to this discussion. One is that I want to tie this back to some work that Lars and Tom Sargent are doing on robustness. How do we thinking about our economy, the robustness of the decisions that we face as policymakers, and are they robust across the range of either models that we may be uncertain about, or the parameters of those models? How do we think about that, and how does that affect our policymaking decision? The second dimension of that is that one of the things I found frustrating is the tendency of financial markets, the press and others, to kind of think about a false sense of precision with which we can do things. So I'll give you an example. When the Fed publishes each quarter what they call the summary of economic projections by members of the committee, it's a survey, and it's a question about what members of the committee think about the economy and so forth. So I'm always struck by when the committee, let's say, in one meeting they have a forecast, if you will, of GDP that's, I'll make up a number, 2.7%. The next meeting, the number comes out to be 2.5%. Headlines reads, committee slashes forecast for the future. I'm not kidding, that's the way it works. Who can tell the difference between 2.5 and 2.7? I can't. I don't think Lars, even as a econometrician, he can't either. The standards are our ability to measure and the uncertainty. I mean, just think how often GDP and other economic statistics we look at get revised. They change a lot. So there's this focus on point forecasts that I find very objectionable because it sends the wrong message. So the Fed, in particular, from my perspective, needs to talk more about uncertainty, more about the imprecision both of our knowledge about the state of the economy, and also more about the knowledge and precision of our forecasts and our ability to measure those things. So what does that mean as a policymaker? So as a policymaker, then you have to think hard about that uncertainty, whether it be measurement or whether it be model uncertainty. You have to think hard about that in terms of how you think about the appropriate policy. So sometimes I've given actually a number of speeches on things like this, where we need policymakers, particularly in the realm of monetary policy, but in other areas as well. I think we need to have a little less hubris and a little more humility about what it is, in fact, we can do, and the precision with which we can measure the effects of what we, in fact, do. So I'm going to tie this back to Milton again, because in his presidential address in 1967, Milton had a quote, and of course, at that time he was railing against sort of traditional Keynesian models of the 60s. But he said, "We are in danger of asking monetary policy to play a role larger than it can play, to achieve tasks it cannot achieve, and in so doing, putting at risk the contribution that it can in fact make." If there was ever a quote that I read when I was a graduate student, which I think applies today, it's that. As Lars said in the sort of end of his question, around the world, whether it be the United States, whether it be the ECB, whether it be the Bank of Japan, whether it be the Bank of England, my personal view is that more and more is being asked of central banks and monetary policy to do things that they're not typically well equipped to do. And I think that's dangerous. I think they will fail at it. And in doing so will undermine the credibility and confidence that the public has in central banks, which is incredibly important. And yet the pressure is from, whether you want to call it the fiscal authorities or other parts of government, to want to, when they don't want to do something, let the central bank do it. I mean, you can look at this in Europe, in the ECB, who had pretty high constitutional protections, but the political pressure on them to do things that perhaps they weren't well suited to do in order to protect the fiscal authorities, I think is sad. And I think it's problematic for them, and it's going to be interesting how this plays out. The same thing's true in the Bank of Japan. The same thing's true here in the United States. So I think one of the messages I take away from this uncertainty is a little more humility about what we can do, and a little more recognition that monetary policy and central banks can't solve all the economic woes that we have. And it's dangerous for either the public or the central bank to think that it can. And I think we've had some of both of those. There's been a lot of pressure on central banks from the public and from fiscal authorities, but I think central banks have willingly accepted that and done things that perhaps they shouldn't have done, because they felt like either they were pressured to, or they wanted to, or they thought they could fix the problem. So I think humility, this notion of humility, means central banks kind of move more slowly, but they also don't promise, they reduce the level of promises that they think they can deliver on. Does that sort of answer your question, more or less?
Let me grade you here.
Well, you said Charlie Evans flunked, so I'm just trying to do a little better.
I did not say flunked. Now I'm going to get in trouble.
No, you did. No, you did. He evaded the question.
So let me turn to the construct of forward guidance. Forward guidance, there was an academic literature that flourished a few years back. It said, well, suppose that we, in a regime where we're at the zero lower bound, suppose we have the Monetary Policy Authority state very explicitly exactly under what set of circumstances we will push out of the zero lower bound. They provide that forward guidance. The public understand what's going to happen, and people work through that that forward statement alone, that type of confident forward statement could have a positive policy impact. And there was, many papers on trying to defend this and argue for this type of approach. Now let's go to the actual, what I observed to be monetary policy. Seems like the messaging since this policy was implemented lacked some clarity. At least it certainly wasn't always evident to me. And instead, there seems to be a competing desire on the part of the Fed to be flexible in their decision making. Now we want to look at more, a whole array of targets in order to, before we make our decisions about when to move out of the zero lower bound. At every meeting, there's a speculation, will it be this time or next time and the like. This doesn't look to me like forward guidance is being implemented. To what extent did concerns about clear messaging versus flexibility show up in the policymaking discussions? And doesn't the lack of full clarity work against a basic premise of forward guidance?
Yes. I agree with what Lars said 100%. And forward guidance, as it is described and thought about in models, is quite specific about what it's supposed to do. In those models, forward guidance is the actions of a policymaker who was previously following a rule and a very predictable policy, promises to deviate from that policy in the future. Promises to deviate from that policy. And you get the good results from that forward guidance because everybody believes the policymaker is going to deviate from what they otherwise would have done. That's the way the models work. I think that's right, Lars, isn't that? Okay. Now, in practice, the problem is, and I dissented a number of times about language in our statements about forward guidance. That's not the way the Fed behaves. First of all, the Fed never had a rule. And so it's hard, the Fed refused and never has described, at least ex ante, what its policy strategy is. But then it goes about in promises that it's going to deviate from that. Well, deviate from what? Who knows? Okay? The other piece of it is that at the same time, they couldn't articulate, as a committee, we couldn't articulate, and I say we at the time, we couldn't articulate what our strategy was. At the same time, we would then say, yes, but we could change our minds. We're going to be data dependent, whatever that means. Okay? So the whole debate, one more thing. The first time the Fed gave forward guidance, not the first time, but in this recent episode, was August 2011. And if some of you remember, that was the date in which the committee declared we won't raise interest rates at least until summer of 2013 or something like that. That was supposed to be some kind of commitment. We didn't say what that commitment meant. We just said that was a commitment. Now, in the models, the way that commitment was supposed to help things today was that everybody would say, oh, wonderful, the Fed's going to keep rates so low for so long that we're going to get a boom and I'm happy. That's not how it got interpreted. Most people in the country, we can talk about financial markets a little differently, but most people in the country said, oh my God, the economy is going to stink for at least the next 2 years. That's not the signal you wanted to send. In fact, it's exactly the wrong signal that you wanted to send. So from that standpoint, the forward guidance was kind of a bust from my perspective. And it was a bad strategy because the Fed couldn't really commit to that. And of course, it didn't commit. It kept changing the rules of the game and changing its standard, changing its metrics. So my view was that forward guidance of the form the Fed tried to practice, which was, in my view, again, this is not shared by everybody, my view was forward guidance was practiced as if the Fed could manipulate expectations as an independent tool of policy. I don't know what made us think we could do that. or control what people's reaction were to our signals. My view of forward guidance is that there's a limited amount, that it's not an independent tool. Forward guidance can only be part of your monetary policy strategy. So I am more of a fan of, rather than offering forward guidance, the Fed ought to be seeking to describe what some people call its reaction function. How will monetary policy respond to the data? Data dependence is right. But what the Fed hasn't done is say anything about how it was going to respond to the data. If I told you that the Fed was going to react to future data, they don't know what the future data is going to be, but you can begin talking about rules, or you could talk about reaction functions that say, how will the Fed respond to future data? That's not a promise about rates. It's a promise about how the Fed will react to circumstances in the future. That's about the best you can do. But the Fed doesn't want to do that. So really the forward guidance debate, in my mind, was a classic example of the rules versus discretion debate. And it just manifested itself kind of just out loud. Because the rules versus discretion debate, the Fed has never wanted to follow a rule of any kind, or even use them as benchmarks or guidelines. They want to maintain discretion. They want to maintain flexibility, optionality, as some of my colleagues used to say. Well, discretion is not a strategy. It's not a strategy. It's just sort of, I'll be able to do what I want when I want to do it when I think it's right. Wonderful. How can you design forward guidance and to commit to doing something when you still want to be discretionary? You can't have it both ways. What the Fed, in my view, tried to do was to have it both ways. They wanted to use forward guidance to signal a commitment, but then always backhanded say, they didn't say it this way, but they wanted discretion to do what they wanted to when the time was right. Those two things, you can't have your cake and eat it too. So I think forward guidance was not effective. I think it was confusing as a communication device. And the tension between trying to use forward guidance, which works only as a commitment, and at the same time maintain discretion, were just incompatible with each other. And I think that was a source of a lot of the communication challenges the Fed faced during the 2011 through 2015 or 14 periods. So I think forward guidance is fine when you look at it in the context of a specific model. I understand that, and it works. But if the Fed doesn't follow the premises of which the model is based that gives you that result, it doesn't work, and it actually can backfire. So I was really not a big fan of forward guidance, at least as the Fed tried to implement it.
Okay. So you talked earlier about the dual mandate, inflation and employment. So from my own perspective, if we really want to support labor markets, we have to provide a healthy environment for the creation of new enterprises to nurture, in order to nurture job growth and long-term productivity gains and the like. Of course, under this view, making sure financing is available for these activities is important. How much do considerations like these play in your thinking about how the Fed should influence job markets?
Well, I think you have to ask yourself the question, how do you think the Fed influences job markets? What it is can they do about the job market, about the labor market? I'm not going to say they can't do anything. I mean, but a lot of things affect labor markets that have nothing to do with the Fed. So I would point out that in January of 2012, the Fed published for the first time an inflation target, and but also explained that we don't have, or the Fed didn't have, a numeric labor market target. And the reason they didn't have a numeric labor market target was because too many other things influence the dynamics of the labor market beyond monetary policy. And tax policy, labor, I mean, there's just a whole range of things that influence the dynamics and structure of the labor markets that go way beyond the things that the Fed has the authority to do. So I think part of the question is, what do you think the Fed's calling is, or ability to shape labor markets? And my own view is I think it's fairly limited. I think I said earlier, I gave this talk a few years ago about a limited central bank, and I'm a fan actually of thinking about having the Fed have a single mandate, price stability. That's something I think we know central banks can do, at least under a fiat currency, can do over the longer term, maybe not month to month or week to week. It simplifies their tasks substantially, particularly when you question whether or not the degree to which they can actually influence the labor market directly. So I guess I kind of go back to where actually Alan Greenspan was. He said, well, the best thing central banks can do to foster a well-functioning labor market is to have price stability to help simplify the resource allocation problems of the private sector, prevent volatility to the extent they can, and provide long-term price stability. I think this goes back to, I think, our first question, or so maybe there was a second question about having some humility about what the central bank can do and what you can do as a monetary policy maker. You often hear the Fed has shifted, that's pejorative. The Fed's moved around its sort of criteria for goals and objectives for the labor market. It started to be unemployment, then it became labor force participation rates, then it became too many part-time workers versus full-time workers. And so you have this sort of shifting ground. I don't know, I mean, I'm sure I could build a model of the labor market for which monetary policy has some role to play in the mixture of full-time versus part-time workers. Probably could build a model like that. But I don't know of any existing model that tells me the Fed's really monetary policy can really do much about that. Similarly, you know, what's the role of monetary policy in changing labor force participation rates? I don't know. So there are just too many other factors that influence those sorts of choices in the labor market. And for the Fed to take those parameters on board as if they are goals and objectives of monetary policy, I think is unwise. So I guess I go back to what I said a moment ago, which is I think for monetary policy, the right thing to do is think about providing an environment of price stability as best we can. Now, let me move away from monetary policy, talk just a moment about financial regulation. So you might think in that dimension there are other things as a regulator that the Fed might do in terms of making sure our financial markets are, maybe it's financial stability, maybe it's regulating rules and or controlling rules and regulations for how financial institutions behave in a way that provides for a stable investment environment from a regulatory point of view. But that's kind of a different angle and one that you'd have to think hard about. Again, what are the roles of regulation in providing the kind of environment that Lars is talking about in terms of both investment and opportunity that in turn create a prosperous environment for the economy at large? I think that's kind of a different set of questions. And again, whether you want to imbue that or embody that in either legislation or in the regulatory process. And I think that's an interesting question. I'm not sure I know the answer to that, but it's a different question.
Okay. I'm going to ask one more question, then I'm going to turn this over to the audience. Ben Bernanke once described the most FMOC meetings as boring and scripted. And I'm going to quote Ben. They get lots of attention. Most of them are deadly boring. They are very scripted. The staff do all the work. They write the communique in advance of the decision making. You were a participant in many such meetings. Would you agree with this perception?
So they are scripted. I mean, there's a structure to an FOMC meeting that's followed on a pretty regular basis. There's nothing wrong with that per se, in the sense that you got a committee with 19 people sitting around the table. If you're going to accomplish anything in 2 days, you got to have a structure to that meeting. Otherwise, it just sort of deteriorates into sort of chaos. You don't get anything done. So they are scripted in that sense. Now, a lot of people, some of my colleagues from the FOMC, some governors and some other presidents at times have argued, well, you know, everybody comes with their prepared statements. There's no real give and take. There's no real argument that goes on. I guess I don't think that's the right way to think about it. So let me give you an example. Yes, governors, presidents often come with scripts, maybe is a little disingenuous way to describe it, but notes about what they want to talk about. But what they want to talk about is not just arbitrary. You know, the notes they want to talk about may be things that are going on in their district about the economy and the mosaic that we're trying to paint for the economy as a whole. But on a policy side, all the debate doesn't just occur in one meeting. It occurs meeting after meeting after meeting, sometimes ad nauseum. That's sometimes when they can get boring. For example, the Fed debated creating an inflation target for at least 20 years. 20 years. Well behind the creation of inflation targets in many other central banks around the world. So the debate about an inflation target wasn't just some scripted argument that occurred in a meeting and everybody came with their planned comments and there was no real debate. These are debates that go on and on and on and on and on. And so when a president or a governor comes in with something that he or she wants to say, what they want to say probably comes from something that was said at the last meeting or 2 meetings ago about a topic or a debate for an issue that's been going on for some time. The Fed's debated its what we call exit principles just for years and modified them and changed them and argued about them and debated them. You know, they've talked about the so-called reverse repos that are sort of all hot in the market. They've debated that for 2 or 3 years. So, yes, the meetings can be boring sometimes, I agree. And yes, they're a bit scripted. But that doesn't mean they're not without content and significance. Because the nature of the debates that go on, typically, nothing's ever decided, or preferably never decided, about a debate that occurs at one meeting. Occasionally it happens, and when it does, it's usually not good. But the debates occur over many meetings and over time. Staff present memos. They do a lot of work. Staff present memos. Members of the committee will chime in about what they thought of those memos, what they think about them. Did they think about this? Why didn't they write it this way? What about this? What about that? And then you'll see those memos recirculated, not next meeting maybe, but maybe 6 months later. The issue will resurface again with revisions to those memos and changes. So while, yes, there's a certain amount of scriptedness and there's a certain amount of boredom to them at times, I think serious deliberations go on and serious debates go on within the meetings over a period of time.
Okay, with that, I'd like to open it up to the audience for a few questions. Yes, let's see. There should be a microphone coming.
Hi. So I hear that the Fed is asked to do more than it's comfortable doing. It sounds to me like this is an issue of resetting expectations with policymakers and the public. So if you had a magic wand, how would you do that?
Oh. I don't know. I'm not sure I have an answer for that. But I would say this. I think you're exactly right. Part of this is that for whatever reason, expectations have risen about what the power of central banks have and what the problems that they can address and solve. I think that has evolved over many, it's not a recent phenomenon. I think it's evolved over many years. I don't know how to solve it, but I do worry that the reaction to that has been to ask central banks to do more and more, and to expect them to do more and more, and even incorporate that in legislation at times. And I think, or I wish, maybe that's a better, my wish is that central bankers would stand up and say, stop, wait, we can't do this as effectively as you can. I sometimes use the analogy, I heard so much during the crisis that the Fed had to act because it was the only game in town, right? Fiscal policy was immobilized, Congress couldn't act, it was up to the central banks to do something. And I sort of understand that, but I also would argue that there's a little bit of analogy here in medicine. So monetary policy and fiscal policy are different tools. They work different ways, despite what Keynes said. They work through different channels, through different mechanisms. But like a doctor, if you don't diagnose the problem correctly, you can prescribe the wrong medicine. And the wrong medicine can actually make the person worse off if you're not careful. So I think my analogy here is that this argument that says monetary policy has to act as a substitute for fiscal policy is kind of like saying, I don't care what the diagnosis is. I'm just going to, this is what I've got in my medicine cabinet, give it to the patient, and maybe it's the wrong thing, and maybe it's not, maybe it'll work, maybe it won't not, but you've got to act. So there is this pressure in Washington and among policymakers where you say that the pressure is, do something, fix this. And the reaction is, you're not doing anything. Well, the right answer, in fact, may be to do nothing. It's not always, what have you done for me? It's sort of, maybe the right answer is do nothing. Patience sometimes is the right answer. So I don't know how to combat that, except I think policymakers and people, intellectual leadership, whether it be policymakers at the central bank or academics, need to stand up and say, wait a minute, we are imagining the powers of a central bank to do things with such precision and such laser accuracy on a problem that somehow they can fix the labor force participation rate, or fix the problems in the MBS market, or fix the problems in some other market. I think that's back to this humility and this sort of uncertainty about the effects of what we can do. So I don't know how to change that. It's been built up. I often refer back to the book about Alan Greenspan titled The Maestro. To me, that was the wrong message to send. Ben Bernanke actually, I'm going to take a tangent on this just because it's something that interests me. Ben Bernanke came to the Fed saying one of his goals was to depersonalize the chairmanship. That the credibility of the institution, now we're talking about 2005 and 2006, the credibility of the Fed rests in the institution. It shouldn't rest in whoever happens to sit in the chair. Ben felt very strongly about that, and I agree with him 100%. Now, obviously, the crisis came along. That plan of Ben's kind of got blown out of the water because it all began to focus on him. But I don't think that's what he believes is the right way to run the Fed. It ought to be about the credibility of the institution. So, but it's too much about the Bernanke Fed, the Greenspan Fed, the Volcker Fed, the Burns Fed, the William McChesney Martin Fed. It's too much about the chair. And we ought to create enough confidence in the institution And it doesn't really matter, or matters a lot less, who sits in that seat. So I'm going to give you an example that I think is really kind of fascinating, and this is mostly food for thought. During the height of the crisis at the Bank of England, the Bank of England has a 9-member policy committee. They would have votes of 7-2, in some cases 8-1, 7-2, 6-3, 5-4, all the time. It was not unusual to have this wide range of diversity in the views. At the Fed, it's all about, or at least it has been for the last decade or more, consensus. And the press and some market writers talk about, oh, well, they can't have more than 2 dissents or 3 dissents. That would be terrible. It would be a lack of confidence in the chair, or something to that effect. And so governors now don't dissent. They would rather resign than dissent. I think that's a terrible state of affairs. Didn't used to be the case. Volcker had dissents from governors, and Arthur Burns had dissent from governors all the time. It was not unusual at all. I wish we could get back to that model. So I'm going back to the Bank of England now. Mervyn King, when he was governor of the Bank of England, actually was on the losing side of several votes. Now, that wasn't frequent, but so I was talking with a friend of mine who was on the Monetary Policy Committee there, Paul Tucker, and we were talking about this actually this spring. And I said, I thought that was an incredibly wise decision. Even if he didn't really want to dissent, what message that sent was that this is about the committee. It's not about me. And so if you ask yourself the question, how do you build confidence in the institution? I have no idea whether Mervyn, I've never talked to Mervyn about this. I've talked to him about a lot of different, I've never talked to him about this particular. But in thinking about it, I sort of said, boy, how smart was this from the perspective of saying, this is about the institution. It's not about my position. And I don't think that could ever happen at the Fed right now. I would love, because that's the way, for me, that's one way you build confidence in the institution rather than the individuals. But that's not where it is.
So we have time for just one more question with a hopefully short answer.
With a short answer?
Yeah.
Okay.
Should I?
If it's a long answer, we have time for no more. Go ahead.
Okay. I have a similar question, but a different angle. And I want to start out with something Milton Friedman said, because both of you used Milton in your question or answers. When Milton was thinking about good intentions and bad outcomes, he apparently made a remark such as, we need a system, especially in public policy, where the structure is such that even the wrong people will be forced to make the right decisions. Obviously, that's kind of difficult. So my question with respect to the Fed, its increased power both in terms of monetary policy, regulatory policy, supervision policy, the power to determine who is a SIF fee, who is a SIF move, et cetera, et cetera, et cetera. Do you think, even if it could do all of this, that it is a good thing in a free and democratic society to give an organization that's really not responsible and answerable to anybody this kind of power?
So, let me offer two kind of dimensions. I talked earlier about my view of a limited central bank. I think one way to deal with the issues you're talking about is not to keep giving the Fed or any other agency more and more discretionary authority. What you really need to do is narrow their focus, narrow their discretionary authorities, make them behave in a more narrow sense so that, in fact, you can hold them accountable. I think my view about central banking in general is to, rather than keep increasing the scope of their authorities to control the whole economy, is to begin to narrow it. So the second dimension to that is that one of the things that I think would be terrible, or let me pay it a positive way. One of the features of the Fed, the central bank that we have, is, in the way it was designed, is its decentralized nature. 12 independent reserve banks who are not political appointees. Some people view that as a bad. I actually view that within the Fed as a system of checks and balances. It's a way to diffuse authority, to reduce the ability of sort of capture, if you will, in some dimension. It's a way to promote or reduce the tendency for large, powerful institutions to get into a groupthink mentality. And so I actually think the decentralized nature of our central bank is unique and valuable, somewhat cumbersome at times. As someone who tried to operate in governance in that environment, it's not the easiest environment to govern as an organization. But it serves a function. It serves sort of a diffusion of authority, decentralized power. I mean, one of the worst things I think Congress could do would make all the 12 bank presidents political appointees. If you want to make the central bank more political, well, then that's fine. But I'm not sure that would be a wise way to proceed. So I think I think I see what you're getting at, but I think there are ways to offset some of that in any kind of organization.
With that, I think I'd like to thank Charlie Plosser one more time for an excellent session and for his thoughtful comments.